Good morning to all you free subscribers to my Substack publication and YouTube subscribers. After a pretty busy week in New York, we wrote Quadrilemma Back on Track, which is a reference to the our theory that in order to get the Fed to cut to 4%, the level we think is required to disinvert the yield curve and take the pressure off the small regional banks, reopen the bank credit channel, which will allow banks to roll over multifamily real estate projects under construction, help finance the federal government and finance small business. We'll need and keep the 10-year note yield in the vicinity of 4%, hence sort of a bull steepening of the curve that does no more damage to bank balance sheets. We'll need the unemployment rate to rise above 4 and wage growth to fall below 4, but we do need to have that happen in fairly short order, say in the next month or two. Last week's report was a very significant step towards getting back on track towards that quadrilemma thesis of ours. So hence the title of the report. We wrote a lot about the labor market, and I'll summarize that shortly for you. We then also discussed a couple of other things that we observed during the course of the week. One was just our discussions with clients and how various scenarios for what could disrupt the current technology-led rally in the business cycle. We then discussed our takeaways from the monetary policy report to Congress. It was not a dovish presentation. There was no news on monetary policy in that discussion, but there was some very significant news on bank capital that led to a slight or contributed to a slight tweak in our sector allocation or modest changes. We discussed financial conditions and how they're very tight for the banking system and anyone that relies on small banks, but easy in a number of other ways, say credit spreads, large non-financial corporates. And we see the key point of differentiation as tight monetary policy, loose fiscal policy. And so wherever that fiscal policy is being directed, conditions are loose, like households, but where it's not, where monetary policy is the primary source of liquidity, conditions are significantly tight. And then wrapped it up with this small or modest change to our asset allocation that I mentioned. So first on the labor market, we had discussed the previous week about how there were so many questions on the demand for labor, supply of labor, and the price or wages. It's now pretty clear to us through all of the data that came out last week that small business employment is continuing to weaken. There has not been a big recovery in large non-financial corporate hiring. The labor market demand is clearly softening. The work week rebounded, but it remains at the lowest level for last cycle since 2010. The chart that I have here, if you're looking at the YouTube video, you can see demand and supply both coming down. Just across a range of indicators, in fact, total hours worked are flat so far this year, which actually argues for a decent productivity gain in the first quarter, but that's a story for another day. Demand definitely looks to us like it's weakening, notwithstanding the headline number. Of course, there was another very large revision getting back on track with that pattern. And we think the way that the BLS estimates small business employment, the birth death model is way off track. The NFIB survey is weakening and ADP small business hiring is weakening. But most importantly, labor market churn or reallocation took another leg lower. And that to us is what's ultimately going to lead wage growth below 3% in a year's time is what our model forecasts. We may not get there, but it's definitely weakening. The supply numbers improved. Prime age participation went back to its high that it was reached in the second half of last year, which is the highest level since 2002. And for female prime age employment or participation, it went back to a level it reached last year, which is its all-time peak. So very good news on the supply side. And wage growth, of course, was very tepid. And again, the labor market, if we have a similar performance next month where the unemployment rate jumps another 0.2, we think the Fed will be in easing mode, maybe as quickly as May. We'll have to see, but it was a very positive step forward. So Moving on to market outlook and our discussions with clients. We went back and forth about whether a real rate shock, say 10s going back to 5%, was more likely to cause a sell-off than a growth scare related to our quadrilemma thesis. The difference in those two scenarios, really, and either one of them are reasonably probable. Splitting it down the middle seems a low delta outcome. So we do think we could likely get some sort of a disruption here. But the difference is if we have that real rate shock and the market sells off in a broad risk-off episode, you're supposed to buy tech. If it sells off because of a growth scare, that's the opportunity to potentially get involved. And the Fed's headed towards 4%. That's an opportunity to get involved in banks and potentially small caps. Again, just some scenario analysis. So this final point I will make here and then move on and end this summary of our note. And by all means, consider becoming a full subscriber so you can get all the details to this. Is that the big takeaway from Powell's testimony is that he is not on board with the administration's bank capital plans. Those bank capital plans for us would ensure that return on equity in the banking system drops below 10% and the sector becomes uninvestable like it was in the 50s or the 2014 to 2018 period. That seems to be off the table right now. And keep in mind, this is a highly political argument or discussion. If the current front runner, former President Trump, wins, those proposals will never go through. Bank profitability will be better. And that's one of the ways to think about, is the market discounting one election outcome or another, is to watch the financial sector, because the biggest beneficiary in our view of a Trump presidency would be the financial sector. So that's it for me, Barry Neff from Ironsides. Again, please consider becoming a full subscriber, either to the podcast if you want that, which is a more detailed discussion, or please consider being a full subscriber, reading our notes. There's a lot of work that goes into them, and they're very detailed. Barry Neff from Ironsides, thanks.